business, you're in trade business where you buy stuff and then you resell in the market, you must be having a minimum risk reward ratio. So for instance, let's say you deal with laptops. So you import laptops, each laptop will have a unit cost, and then you sell it in the Kenyan market. So if you're buying one laptop at, let's say, $1,000, you don't want to sell that laptop at 1,001 because the risk reward ratio would be very small, to be not be very nice. But then if you identify a market where, let's say, if you import a product and then you sell, you're making double the profit, then that qualifies as a good trade because the risk reward ratio is 1:2. So every time you take a risk by buying a laptop at $1,000, you're able to convert and sell that laptop at $2,000. So the same case applies to the markets. You don't want to take a big risk when the reward is very small. So you want to have a minimum risk reward ratio where if you take a position, there is a certain expected return from that position that is significantly higher than the risk you are taking. And this is the beauty about Forex compared to these other markets. You're able to take a small risk and then get a potentially higher return. So let's see if you can do an example. Let's say you are trading US oil. This is US oil. So with US oil, just want a clean chart here. This is what has been happening. The market has been going down, and then on Friday went up and then back down. Then today has been going down, up, and now it seems to be going down. So let's say after you've done your analysis, you realize there's a potential trade where the market can move, let's say, to Thursday's low. So the lowest price on Thursday is indicated here. So this is Thursday's low. So just a moment. And also, if you are wrong, you can choose to exit the market if it goes to today's high. So if the market goes back up and gets to this point, then it invalidates your position. So if you identify this as a trading opportunity, then you want to know what is the potential reward for every dollar that I'm risking in this market. So you just use the crosshair tool to measure the number of points. So from the entry point to your stop loss, these are potential 1488. Okay, let's use something like 1500, round number, make it easy. So you'll be risking 1500 points. But then if you're right and you win, then you're making around 3000 points. So this basically sounds like a 1:2 kind of position where the risk here is 1500 points. And the potential reward, that is, if you're right and the market drops all the way down, this is 3000 points. So for those who are not conversant with points, every top 10 points make a pip. So this would be 300 pips versus 150 pips. So in this case, the risk reward is 1:2, meaning that for every dollar you invest in this position, you will be looking to make $2. So if let's say you are a trader and you have set your minimum risk reward ratio is 1:3, then this position might not appeal to you because it doesn't meet your minimum requirement. But then if your risk reward ratio is 1:2, then you'll go for such a position because it qualifies for that requirement. So if your risk reward ratio is 1:3, then you move on and look for another position that has the potential to give you such an amount. So let's say we try this again, but now with gold. So let's say you are trading gold, then you do your analysis, whatever approach you are using, you realize there's a triangle and the market is breaking downwards. And let's say, just for demonstration purposes, you want to go for a short position, targeting the previous low here. And if you're wrong, then you get invalidated using the red line here. So you go for a short selling position, your stop loss goes here, and your take profit goes all the way down to the previous low here. And this is the low we saw on Thursday. So now we try and calculate the risk reward ratio again. So from your entry point to the stop loss here, is clearly 700 points. And then on this other side, we have 2257. So using my calculator real quick, I'll be doing 2257, 2257 divided by 700. And this gives me what? Sorry. So this gives me 3.2242. 2257 on one side, 700 on the other side. So the risk reward ratio is significantly better. And in this case, more than $3 for every dollar that I risk. So this side is 700. And this other side is 2257. And now, if I take 2257 divided by 700, then what I get is 3.22. So for every dollar that you risk in such a position, you'll be expecting to make $3.22. Meaning that if you have decided that your risk for this position is $10, then you'll be expecting to make 3.22 times 10, which is $32.2. And now this qualifies as a good position if your risk reward ratio is 1:3. So now the other point you want to focus on is to know what lot size you need to trade in order for you to risk exactly $10 without risking more. And if you're right, you, let's say, make your $32.2. So this is where the position size calculator comes in. So you will need to find a position size calculator, one that has the particular asset that you're trading. There's a lot of position size calculators available online. You can find one on the Baby Pips website. You can find one on my FX book and all that. So try and look for one online quickly. So let's see if I can find one with gold. All right, I think I found one on our website that is very popular. It's called the My FX Book website, myfxbook.com. So I'll be sharing that with you. So there is the link. So with my FX book, we want to do a very quick calculation to see what lot size to use in this trade. So the account currency is in US dollar. Let's say the account size is hypothetically $1,000. So you have deposited $1,000 in your account. So you want to risk 1%, which is $10, and your stop loss in pips, as we have seen, is 700 points, which is basically 70 pips. So the trade size in lots is 0.001. No. So this is what we want to calculate. So trade size in lots, let's see. So trade size, this should be the size of your position. Oh, 0.01, sorry. So yes, this is it. So now, after you've set your currency, which is gold against the US dollar, the account currency is US dollar, account size is $1,000. Risk ratio In this case, you're looking to risk 1%. You can also swap with money. You set the amount of money that you want to risk here in dollars. In this case, it's $10. Stop loss in pips is what we have seen here. So just to put a reference here is the difference between your potential entry and your potential stop loss. So you want to enter a short selling position here and set a stop loss here. And the difference is 700 points, which is equal to 70 pips. So when you go to your position size calculator, you just type 70 right here. So the trade size in lots, the minimum here is 0.01. And once you calculate, the risk ratio is 1%. Units traded is 14. So the sizing is 0.01 lots. So you are most interested with the sizing. You want to know the lots that you will trade for that such a position. So the minimum that you trade here is 0.01 in order to risk $10 and target to make, in this case, 3.22. So once you have identified the lot size, the next step is pretty simple. Go back to your trading chart, click new order, and then set the identified lot size. So in this case, we have seen 0.01, and then execute your short selling trade. Click, hold, and drag to your stop loss. So sometimes it will be a little bit different. In this case, you can see it's a negative $7. So by this being negative $7, you can see on this end here, if the application recommended 0.02, then we'll be risking $14, which is higher than the risk appetite. So in this case, we choose the lower side. So in this case, we'll be risking $7 in the position. And then, if you're right, remember the risk reward ratio is 1.322. So this would be 7 times 3.22, and this will be the outcome on this other end. So now you're making roughly $22 on this position. So now you can comfortably go do some other stuff after executing your trade, knowing that the worst thing that could happen in this position is the market heading straight for your stop loss and you get stopped out at negative $7. But then, if you're right, the market goes towards your end target take profit, then you make $22.33 in this case. So understanding that concept makes it easy for trading because you're able to risk a small amount of money that is within your risk parameters, and then patiently wait for the market forces to play out until you are either validated or invalidated. If you're validated, market hits your take profit and you cash out a happy person. And then if you're wrong, then you take a loss and you look on to the next position. So the idea is, and I'm going to put this in perspective, is that if let's say you are flipping a coin. So if you are flipping a coin, let's try and even draw the coin itself. We know that a fair coin will have 50-50. This is a 50% probability to get heads. So if you flip that coin and you keep doing it, you might get the first time you have a head, the second time you have a tail, the second time you have a tail, and then a tail, and a head, and a head, and a tail, and so on. But then if you do it a large number of times, then the mean will approach 50%. So if you are betting against your friend with a coin, you flip the first time, you get head, your friend flips, they get tails, and you keep doing that over time. If you do it for 100 times, there's a good chance that you will be having an outcome that is close to 50, where let's say you win, let's say 47% of the time, and your friend wins 53%. Or it can be 48, 52, it can be 46, and then 54, and so on. However, if the coin was not fair and had, let's say, weight on one side, so this coin is not fair. So, and if you keep flipping, let's say it has a 70% chance that you get heads. So let's say you are doing this with your friend and your friend doesn't know that. So you choose heads and you choose tails, and every time you flip, you might be getting head, and then your friend gets tails. You keep doing it and you do it a large enough number of times. Then if let's say you flip 100 times, you will realize that you have most of the outcome winning compared to your friend. So if let's say you are winning positions, let's say 65, then your friend has 35 wins. So if let's say your wins are let's say 67, then your friend has 33. So the only way you're able to achieve that winning outcome against your friend is by having a large number of flips. So if you only flipped once, then there's a 50% chance, even though the coin has weight, you just flip once and you could get a head, you could get a tail. But if you keep repeating this process over time and you do it 100 times, then you find the probability is working on your side because you know that the coin has weight on one side. So knowing that and understanding how we do this in the markets, when you're looking for trading positions or trading setups based on your particular trading system, you're always trying to find an edge. An edge is a probability that the outcome of your trade will be more than 50%. So if you just play it simple, have never traded before, you enter the market, click buy or sell, then after, let's say, a period of time, after 1 hour, there's a 50% chance that you're winning and a 50% chance that you're losing. So the market can either go up or down, no other way. So even if it's sideways, then there's always some form of incline happening over time. So what happens is that if you're able to identify a trading strategy that has an edge, this could be, let's say, a 60% win rate or a 60% probability that you will be winning in your position and 40% probability that you'll be losing in your position, then it's all a matter of repeated action according to that probability. So repeated action would mean taking more of those trades. So if let's say you find a triangle such as this one and then you execute your trades, then you just want to be pumping more and more of those trades. So you want to be clicking, let's say, buy or sell positions over time. And if you do a large number of those trades, let's say 100 trades, then you find the probability is working on your side. However, you will not be able to do all those positions if your risk appetite is very high. So if you deposit, let's say $1,000 in your account and your trade size is $200, then the maximum number you can lose is 5, and then your account is kaput. So you need to have smaller trades that are spread across a large number of events, where if you keep doing those small trades, then after a period of time, say 1 month, 3 months, then you find your outcome is higher than the losing trades. So it's something that is normal. You'll always have winning and losing trades. So the idea is to make sure that the even or the center between your winning and losing trades is on your side, where you are making more than you are losing in those trades. So you need to identify a trading strategy with a winning edge, then practice the idea that we have talked about. 1, setting a minimum risk reward ratio, and then 2, repeated activity on your particular trading system. And you keep doing that, then you are assured over time to make some good returns on your investment. So I know today has been real quick and real fast. So I'll also be looking at questions from you guys. So I'm seeing a lot of activity here. So a good question, how can I trade in Forex? It's my first time. Just after this session, which is ending in the next 12 minutes, just make sure that you go back to the YouTube channel, search FX Pesa, and then you go to episode 1 of this series, which is the Novice to Pro series. So in this particular series, what we've done, we have gone through different topics or subtopics for that matter. And in each topic, we have covered various concepts that you need to know in order for you to get to this part of risk management. So in the first episode, I believe we covered introduction to trading Forex. There is an episode we covered tradable assets. There is an episode we covered candlesticks, chart patterns and all that. So you have to take your time, go through all the episodes in the series, and it will help you transition from a beginner to a professional level trader. So you have to just take your time, do some practice before you process today's presentation. So in the first episode, it was introduction to chart trading. Second one is charting skills. Third one is tradable assets. The fourth one is know your candlesticks. The fifth one, we covered market structures. In the sixth episode, we covered trading strategies, and today it's a risk management. So hopefully that information answers your question and gets you in the right direction. So another question, I would love to know how to set TP1 and TP2. It's a little bit tricky, so I always advise people to like cut your positions into 2, 3, or 4. So for instance, if you want to have, let's say, multiple take profits in the trade example we mentioned, let's see. So just a moment. So for instance, this is a gold against the US dollar. You have seen the minimum you can trade is 0.01. And if literally you're looking to set your stop loss here, you will be risking $7 and going for a potential profit of, in this case, $22.33. So if you want to have, let's say, multiple take profits, and let's say the first take profit you want to cash out when the market gets here. The second one is, let's say, here. So when the market gets here, you cash out some money, and when it drops all the way down, you cash out some money. So what happens is that if you're trading the minimum lot size, which is 0.01, you'll not be able to have multiple take profit levels. However, if you're a person who trades a bigger trade size, let's say you normally trade a lot size of around 0.1. So let's say your risk appetite is not $7 or $10, it's something like $100. So if you wanted to risk $100, and we look at the multiples of 7 here, which would make it about 14 times the size of this position. So you'd be trading, let's say, 0.14 lots. I'll do this quickly. So just close this. So I click on new order. We have seen that if you trade the minimum 0.01 here, it's $7. So if you multiply by 14, then you would have 0.14. So if you ask me where I'm getting 14, I'm just looking at a person who is looking to trade $100, to risk $100 and divide by $7, I'm getting around 14. So if you execute your sell trade here, and now you set your stop loss, you'll notice that now you're setting this at $100 here. And the take profit, of course, takes the multiple of the risk reward ratio here, 1:3.22. So you get $322 as your take profit here. So now, if you want to set multiple take profits here, it's a little bit difficult on the platform because you can see it's only one take profit. So the way you do this is by dividing your trade. So instead of doing one position where you're trading 0.14, if you wanted to have 2 positions, you can divide that by 2. So instead of doing this, you can do a new order. And then instead of 0.14, divide this by 2 to 0.07. And then you can execute one position, new order, execute then a second position. So this way, you'll still set the stop loss at the same level. And then the take profit, one can be here, or let's say here, and the other one at the far end. So this is the trade without a take profit. So you can always modify. And then for the take profit here, it's on the lower side. Just move it this way. Stop loss, move it this way. Modify. And now you have the orders here. They are clear. So just move these to wherever you want. And these are the stop loss, let's say, to the same exact point here. So now I have 2 trades. They have the same stop loss. So one is risking, yes, one is risking roughly $50 and the other one $50. So the total risk is still $100. But then I have to take profits. So one has a take profit at $106, and the other one has a take profit of around $150. So you can do these to separate your trades, to make sure that you're able to cash out on half of the position and then leave the other position running. So that's one of the ways that you can do these manually, and it can be quite effective. So the other approach you can do, it's called netting. And in netting, you don't have to separate your position. So if, let's say, you have a position that is worth 0.14 lot size, then you click sell by market, set your stop loss, and then you set your take profit. Then you are able to cross a small proportion of this position from your mobile app. So if you log into your mobile application, and whether this can be FX Pesa Trader, can be the MT5 on mobile, that is on Android or on Apple, then you're able to right click on that position. Let's say you right click here, and then you modify it. You want to cross that position, and then you select the position that you want to cross. So you can cross half a position. So from the mobile app, there's a selection where you can select the number of lots that you want to cross. So you don't have to cross the entire lot. You can decide to cross 0.05 of the trade, and then you leave the other one running and so on. So unfortunately, it's not available on desktop, but it's available on the mobile app. So you can always log into the same position, to the same account. You'll view your open trades from your mobile phone, and if you want to close half the position, then you can do that from the mobile app. And it makes it very easy for you to manage your active positions. So another question, show me how to trade. I've shown you the beginner session. That is the Novice to Pro series episode 1. So I'll be sharing the link to on the live chat. So just finding episode 1 here. So hope this helps. So is it advisable to trade using your smartphone? Yes, absolutely. There is no reason not to trade on your smartphone. However, there's a key difference when it comes to trading on your smartphone versus a person who is trading on a desktop, on a laptop computer. So one thing is that when it comes to focus, you're able to focus well on a desktop computer or on a laptop compared to a mobile phone, which is designed to bring you a lot of notifications every now and then. So every time you're on a mobile phone, you can get a phone call, you can get a message when you're actively trying to manage your position or close your position. For some mobile devices, just by receiving a call, it disconnects you from the internet, and you might have to wait until the call ends before you proceed with what you are doing. So you get a lot of notifications on mobile. It's very personal. So unless you're able to manage that, then you'll be at a disadvantage when it comes to maintaining full focus in trading. So the other thing is analysis. When you're doing your analysis, as you can see from my chart, it's bigger, it's better, and it's easier for me to analyze the markets. And that's why I've based the entire series on a desktop and a laptop computer. So when you're doing your analysis, if it's your mobile screen, you'll probably be seeing just this number of candlesticks. So if this is your phone and this is your screen marked by the blue zone, this is the number of candlesticks that you are seeing here. Compared to me, who is trading on a laptop, and I'm able to see all this price history and understand the overall story of this price action. So in terms of analysis, it's easier and faster to analyze on a laptop or desktop computer compared to a person who is trading on a mobile phone. So the other thing is extensions. So you've probably seen traders using extensions where you have 2 or 3 screens that you use for your trading setup. So on one platform, you have your charts where you're observing price movement. And then on another chart, you might have a stream of, let's say, financial news. You could have, let's say, a Bloomberg, either a subscription. You could have, let's say, a live TV where you are consistently watching what's happening in the markets. You could have some set of indicators or analyses on a different screen and so on. So you're able to do all that by connecting multiple displays to your trading machine. So it's very difficult to do that on a mobile phone. So if you're very serious about your trading, I would suggest you use both of them. One for your analysis and executing trades, and the mobile phone for closing or monitoring your position, especially when you are not close to your trading desk. So you're not always going to be glued to your trading platform. So at some point, when let's say you are moving around and let's say you have to travel, move around, go see some clients, you are still in control of your account, since you can quickly just go back to your trading application on your mobile phone, see how the trades have performed, let's say in the last 1 hour or in the last 4 hours, make a decision. If you want to close the trade, you close immediately and without having to go back to your trading setup, at home or at office. So make sure that you utilize both of them. So having mentioned that, I'm still looking for more of the questions that you guys have raised. So how do I locate my stop loss and take profit position? You just click, hold, and drag as I've illustrated. So this is the simplest way of setting a stop loss and a take profit. So for instance, they are marked in red dotted lines. You can see the red dotted line. So this is my entry point for the trade. I click, hold, and drag all the way, focusing on the number of points here and the amount in dollars. So if I want to risk $100, I just set this at $100 and then I release my mouse and it sets that line there. So if the price moves to that point, the trade will close and I will lose $100. So take profit same way, click, hold, and drag, click, hold, and then drag. Once you get to your desired take profit point, release, and this is $311. So price drops to this point, the trade will close, $311 will be added to my account. So remember, in Forex, all transactions are in cash. So if you make money immediately, it's your money. You can choose to withdraw that money. There's no limit whatsoever. But then if you are losing and you lose a trade, then that money is gone and gone forever. So that's why you have to be very, very serious about risk management, because this is the only way that you survive in the markets. So yes, you might find a trader who is telling you, I don't use stop loss. I always am successful, but it doesn't work. In the long run, if you don't use stop loss, you are guaranteed to lose all the money in your account, because you cannot always be on the right side of the market. Sometimes you get caught on the wrong side. And if you don't have a stop loss, the market will just ride your account balance down to zero. So you want to take a quick loss if you're wrong, so that you don't lose too much money in that position. But then if you're right, you want to ride that profit higher or longer, where you make more money from the winning position. But if it's a losing position, you lose a smaller amount of money. So that's the whole idea or concept of trading using a stop loss. So at points and pips, the same thing. They refer to the same thing. It's only that they are different key measuring points. So the same way we talk about a centimeter and a meter and a millimeter, it's the same way we talk about points and pips. So every 10 points make a pip. Every 10 millimeters make a centimeter. So same stuff. Every 10 points make a pip. Every 10 millimeters make a centimeter. So they are just metrics to measure price movement. So kindly explain the lot size for an account of $100. As I mentioned, if your lot size, if your account is $100 and below, trade 0.01. Anything above that, from my professional opinion, it's way too much risk for you. So we have seen for the potential position here on you've seen these on the potential position on gold, where if you trade the minimum position, which is literally 0.01, then the risk you're taking is around $7. So you go to new order, let's say you trade 0.01, sorry, that's 0.01. Let's say you sell by market. This is our position here. So the stop loss here is $8. And the take profit here is $21. So notice that in such a case, by trading the minimum, you are risking $8. So if your account balance is $100, you're already taking a risk of 8% of your account, and that's big. So unless you are very experienced and you have just deposited $100, you don't want to take 8% risk in your trade. So you probably trade less volatile asset, such as the Euro USD, where in this case, you're able to take a smaller risk compared to a person who is trading gold. For instance, if let's say you are trading Euro USD, and let's say you go for a buy trade here. So 0.01 buy by market, and then you set a stop loss here. Notice here you are risking $5, and that would be like 5% of your account. So if you're trading anything bigger than 0.01, then that's a higher multiple of risk, and you are increasing your chances of losing in the market. So take as little as risk as possible. Run fast, understand, have a trading strategy. Once you have all that, then it will be easy to scale up and trade higher lot sizes on an even higher trading account balance. So is an OCO order allowed on FX Pesa? One cancels the other. No, we don't have that. If you use the MT5 or the MetaTrader 5 trading application, you'll notice the orders that we have are basically the same usual stuff. Buy by market, sell by market, and of course we have the pending orders. So for the pending orders, if you go to new order, you can always check these. Pending order, you have buy limit, sell limit, buy stop, sell limit, sell stop, buy stop limit, sell stop limit. So we don't have the OCO. So for those who are new to this, OCO is the short for one cancels the other, where you can have two potential trading entries, and if one is executed, then the other one is cancelled. So what tool can I use to calculate points on my Android device? I mentioned one, which is my FX book. It's there on the live chart. So high between MT4 and MT5, which is better? Of course, it's the MT5. The MetaTrader 5 trading platform is a modern version of the MT4. So it's like asking which one is better between, let's say, Windows 10 and Windows 7. Of course, it's Windows 10 because it comes with more features and it's more updated. So this particular series is based on the MT5. So if you go from episode 1 and episode 2, you'll get all the information that you need to know in order for you to easily navigate through the MT5 and use it for your trading. So I'm not saying don't use the MT4. If you have the knowledge, you can, of course, go ahead. There's not much of a difference. But then if you want to like run with the most modern and efficient platform, then you should heavily consider MT5. So how does leverage affect the account negatively? Leverage will not affect the profitability or the loss of your trade. It's the size that you trade. Remember, if you trade a bigger size, you're taking bigger leverage. If you take a smaller trade, then you are taking a smaller leverage. So I think I already illustrated these with two very rough and badly drawn illustrations, where I showed a very big bag, which is one lot size, and a very small size, which is 0.01. So if price changes significantly, then in fact, it affects the person with a bigger bag compared to a person with a smaller bag. So the leverage you take is determined by the position size that you take in your trade. So the leverage is not about what you set when you are doing account registration. That's only a maximum limit. So if let's say you buy a vehicle, there's that maximum speed. So some vehicles will have a maximum speed of 200 kilometers per hour, others at 180, others at 160, and so on. That's only a limit. But then in actual practice or in driving, when you actually get the car, it's you who determines what speed to drive at in hot roads. So when you get a car that has a maximum leverage of, a maximum speed of 200 kilometers per hour, you can decide that for this particular route, I'm going to drive at 50 kilometers per hour. So it's the same case to trading. So you can open an account with, let's say, 400:1 leverage. But when it comes to executing your trades, it's you who decides that for this position, I'm going to risk $10, so I'm going to trade 0.01. I'm looking to trade, let's say, to risk $20, so I'm going to risk, let's say, 0.02, 0.03, and so on. So it's you who determines the speed to drive at. It's you who determines the leverage to take for each individual position. So a good question from Miguel. Does leverage affect the amount of money spent to fill an order, or it also affects the offset of profits or loss? It doesn't affect the offset of profits or loss on your position. It affects the amount of money spent to fill an order. So think about it this way. If let's say Tesla shares are going for $300 and you are a retail trader, you might not have the $300 in your account to buy 10 shares. So what you do, you take a high leverage. Let's say you take 10 to 1 leverage, meaning that the amount you can buy with your account or with your $300 is multiplied by 10, which now becomes $3,000. So this way, you're able to buy 10 shares instead of buying 1 share. So the outcome of that trade will depend on the direction that the Tesla share takes. If it goes up higher, then you make more profit because you have more shares. If it goes lower, then you also lose in a similar manner. So it affects the amount of money required, or what you call the margin requirement per trade. However, the outcome of your trade is determined by the position size that you take. So hotels, loving this one. BPS increases by 50. I think news activity might drive it. Hence, US and Canadian Bank have Labor Day. Yes, we have Labor Day today. It's a public holiday in the US, so the stocks have not opened. So they will resume trading tomorrow. So today, largely the markets have been quiet. If you look at the New York session, the candlesticks are relatively smaller, not much movement, and that's expected when there's a public holiday because a majority of the participants in the market are not present in the market. So a good question. I've been analyzing my trade that is on demo, but when I analyze the trade, it goes opposite. It can be quite frustrating, especially when you are new in the markets and you have not fully accepted the nature of the markets. So accepting the nature of the markets is accepting that you don't have to be right all the time. So you know that the market does what it does. So my point is, whatever analysis you do, you are a very small trader in a very large ocean of market participants. So what actually happens is that, let's say you execute a trade right now in Euro USD, it's a buy outside 0.01, and then the price goes against you. If you had actually not done that trade and you stayed out of the market would actually have done the same stuff. So it has nothing to do with you. There's no relationship whatsoever between what you are doing and what the market is doing. So the market will still do the same thing whether you have executed your position or not. So having this understanding basically makes sure that whenever you execute a trade and it goes against you, you understand it's the probability that it's not working on your side, just like flipping a coin. So sometimes you just flip a coin, you want a head, and it comes out to be a tail. However, if you have a long-term strategy that gives you an edge, then trust the strategy and then keep trading the same setups. So I know
My world is fast.
Bye.